The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Good afternoon. Doing good. How about yourself?
Good. It's the middle of summer. Almost. Can you believe it already?
It's been hot. Well, our winter was pretty mild, so it's going to be a rip roar here in a couple weeks.
I remember old guys when I was younger, like 40, always telling me, time really flies when you get older. And I said, whatever, old man. It does, actually.
We talked about it last week. 20 years ago, you'd like to lay out in the lake and on a float and drinking a beer, and now not so much.
And it's too hot.
It's way too hot.
I don't like getting out of the shade anymore. I know it's terrible. For those of you new to the show, we developed this show to answer your financial questions. We try to do it as plain spoken as we can. Too many financial advisors start, spewing out Greek letters, and it makes it very difficult to understand. And hopefully you'll do business with us. But even if you don't, this is information you can use right now in your financial lives. Remember, our philosophy is you have to have a retirement plan. You can't go without a written retirement plan. You need to know what your life is going to look like when you're older. In other words, what will 2 or 3% inflation do to your expenses over the next 10, 20 years? What will rising healthcare costs do to your expenses? What if one of your spouses passes away? How does that affect your expenses? That's why everyone needs that kind of thing. We offer it complimentary and no obligation. Don't hesitate to call us if you'd like to take advantage of that. 972-715-2424.
And I'd add real quick, if you notice there was a theme developing, everything, how it affects your expenses in retirement. So one of the hardest things for a lot of our clients and new people to answer for us, and what you really need to get a grasp on so that you can have a successful retirement, is your expenses combined. Figure out what that number is. If you're not quite sure, or if you think you know, but you're not quite sure, call us. We're happy to help. Let's find out, get that as close as possible to what your number is, and then you'll know what you'll need to get it taken care of.
It's amazing to me, the most common thing that happens when people do that exercise, they always spend more than they thought. What people don't have is their hard bills. They got a mortgage, a car payment, They'll estimate groceries or whatever, but there's always a lot more. Like I said, I know. I look at my credit card bills. It's a lot more always. But you need to get a grasp on that to determine you want to maintain the same lifestyle throughout your life if you can. And, they always tell you can downsize. But, the way housing prices go and all that stuff, what you'll find is by the time you pay off a mortgage, if you pay it off in 30 years, your taxes and insurance are higher than the mortgage was with all three of them together when you're younger. Or when you're going to downsize, you don't want a house as old as yours. You want a newer one. You want one with the new stuff in it, right? You'll pay more for a house that's smaller than the one you already have. And so you have to put all those in consideration. Plus, like rising healthcare costs are something you really have to take a look at.
And you'll hear us kind of beat a dead horse, if you will. But once you have those hard expenses taken care of, you don't have to worry about that. It makes it easier to do the other things you want to. If you want to help the kids or the grandkids, it's a great time in life, right? You can share your wisdom with them. You can help them judiciously. Obviously, you don't want to just give the farm away, but it allows you to do that. It frees up your other funds.
Remember, your children can get loans to go to college, loans to get a car. If you can help them, obviously. But you got to have your written retirement plan first to understand if you can or not. Because I'll tell you what, you can get a loan for almost anything you're doing out there your kids got. You cannot get a loan to finance your retirement.
What do they tell you the first thing the stewardess is on the airplane? If the oxygen masks come down, do you put the kids on first? No, you got to put yours on first so you're in a position to help your children. Same thing financially. Put your financial oxygen mask on first, get yourself set up, and you're in a much better position to help other people.
That's right. Again, to take advantage of that no-cost, no-obligation plan, our number's 972-715-2424. Again, 972-715-2424. All right. remember we developed this show to answer your financial questions. These questions come in from emails, from phone calls, from personal interviews, and anytime I find one, or we find one, that we think appeal to a mass audience, we're going to share them with you. And so that's what we're going to do today's show about, is answering your financial questions that have come in the last month or so.
Are you ready for one?
I am ready.
All right. I am worried that they are going to cut Social Security. What are your thoughts?
They actually just did a bipartisan study, put together, what's it called? The Commission on Retirement Security and Personal Savings. It was done by a bipartisan policy center.
That's an oxymoron. Bipartisan?
It was headed by Bill Hoagland, which was a high-level Senate staffer. What do you think they said, Guy?
Oh, I have no clue.
Let's cut benefits
okay.
and raise the amount that they have to put in there, right?
I thought they were going to raise their inflation by 5% a year instead of 3%.
Oh, it's
increases.
Really good. What they did was they came up with a couple of suggestions. The main one was we need more money and we need to pay out less. And so that scares me a little bit. But they also came up with they said anybody with 50 or more employers, they should be required to automatically register people in 401ks. Like right now, it's a suggestion. If you ever, I've done the 401k for our company, and it's a suggestion. We automatically do because we have a certain type of safe harbor 401k. But that's not a bad idea. And they also said if you'll raise the contribution limit a little bit every year, they'll be better prepared for retirement as they get older. Because only about half the people actually participate when offered 401ks.
No, that's true.
And so, remember if you've listened to our show a while, you remember we said, let's say you get a 3% pay raise every year, something like that, or whatever.
Sure.
Why not put that in that 401k? And that way you never see a difference. Your lifestyle doesn't change, but you're saving more for your retirement. So I don't think that's a bad idea. And they said there's another decent idea they came up with. This is called a retirement security plan, allowing multiple employers, even though they're not related by business or whatever, to band together to make stronger 401ks to employees. Because a lot of small businesses, it can be expensive.
That's right.
And so that's a good idea too.
Economy of scale.
That's right. The only problem is it doesn't look at a third of the people out there that are real small businesses and sometimes can't afford 401ks. That's one of the big things. But they also said promote, like split up 401ks into a couple different areas, like one for short-term needs that they can do rollovers before they're 59 and one for long-term needs that they can't. Instead of right now, it's all for long-term needs.
Make it more flexible. That's right.
They also said reduce the risk of people outliving their savings, so have an annuity option on a 401k.
And that's nothing new if you're listening. The teachers have done it for a long time. Most pensions, we've talked about, the annuities have gone back to the Roman times, but most pensions were just that, annuities.
But that's what they're saying. It should be an option on every 401k that person say, all right, I've got this lump sum or I can take this income.
But did you notice they didn't say put the whole thing into an annuity either, did they? They said take a part of it.
It says to use your home equity for retirement consumption. They're talking about a reverse mortgage, using that money. Times have changed. The laws have come along quite a bit on reverse. They used to be the biggest ripoff in the world.
But don't you think
now they're more expensive than regular mortgages, but not horrible?
But don't you think that's kind of a last step now, especially this low interest rate environment?
If you have a plan going in, if so many people go without a plan and then something unexpected happens, that's why I try to promote this thing as much as I can. I know it's like a broken record, but you need a retirement plan. If you've got some of that, you've already accounted for these type of things. And therefore, the transition, the life is still much better if you've already planned for it.
I mean, it's nice to have the reverse mortgage as a safety net, but it's kind of like the last stand.
And the other one, another recommendation by this panel was to improve investor education, which is good. I just don't know if it makes much of a difference because I'll tell you what, 99% of the people you talk to understand they should live without debt and they should pay off their debt and pay off mortgages and all that kind of stuff. And they should save more. It's just life happens.
But that also goes as far as the investors understanding. When you opened up the show talking about this isn't a bunch of letters and garbly-gook, we try to help people understand. A lot of advisors and a lot of folks out there try to confuse them, scare them, fear them into doing something instead of taking that approach and helping them truly be an educator and understand.
Here's the cuts they're talking about. Oh, this is what I don't like, right?
Here we go.
They're talking about they're a self-imposed 50-50. In other words, for every 50 cents that we cut somebody, we got to raise it 50 cents on the other side. Raise revenue by 50 cents. So basically, they're going to take some away, and then you're going to have to pay more into Social Security.
So they're getting 100%, right? They're cutting half what they pay out, and they're getting half more back in.
That's right. All of this stuff. Don't get me wrong. They're going to have to do something for Social Security. Eliminating the cap, which is a ripoff because you already don't get much when you make the higher end. I'm just saying. But that will help Social Security quite a bit. But it just fortifies the notion that the government's not going to help you. It takes you. The only one you can count on in retirement is you. A proper plan in retirement. You can't do the exact same thing you did for 20 years prior and expect that to work in retirement. Don't hesitate to call us if you have any financial questions, 972-715-2424. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're going over your financial questions. Remember, these questions come in by emails, in-person interviews, on the phone, and anytime we find one we think is going to appeal to a larger audience, we're going to share them with you. We don't put out names and all that kind of thing to protect the innocent. A lot of people do that, and they're making it up in the first place. We don't.
Bill called today, and he had a question.
All right, what's the next question, guys?
All right, next question. I'm turning 70 this December. How much do I have to take out of my retirement accounts for the required minimum distribution, otherwise known as RMD?
The law says it's April 1st, a year after you turn 70 and a half. So I think the question was he's turning 70 in December. So if that's the case, it would actually be when he's almost 71 and a half.
Right.
Now, it's not always good to push it out to April 1st, because if you do that, you'll have 2 RMDs that year, required minimum distributions. For those of you who don't know what that is, once you're 70 and a half, the government mandates that you take some money out of your retirement accounts. The only one you don't have to is if a 401k or 457, 403b, if you're still working, you don't have to take out of those. Any other ones you've rolled over, or if you're retired, you have to take out this mandatory amount.
And you may wonder how they come up with, we always tell everyone the first year it's a little bit under 4%. How do they come up with that number? Well, the IRS on their site has your life expectancy chart. And I think at 70 or 70 and a half, the first time, you're expected to live another 26 and a half years. So you divide that into your savings, and it'll come out to just a little under 4%. And obviously, each year we live, it's one less year we're going to, so that number gets smaller that we divide into our remaining assets, and the percentage gets larger, and it grows every year.
One way to reduce it, if you are, let's say, you can do it on a joint life expectancy if your spouse is younger than you. You can only go up to 10 years, even if they're 50 years younger. They can go up to 10 years, but you can take an average. In other words, if you had a 26-year life expectancy and your spouse had a 36-year life expectancy,
absolutely,
you can go right in between it with 32 years or whatever.
Is that going to help you?
That's not going to help me at all.
Okay.
But so that's, if you don't take this required minimum distribution, or RMD, the government penalizes you 50%. Not 15, 50.
Yeah.
And so now why do they make you take out of your retirement accounts? Well, they've never got tax money. Remember, you could have kept this money in there for decades. Even though 401ks came around in the 70s, but really didn't come into appeal until the 80s.
Mid-80s, that's
they
right.
Were broadly distributed in the 80s.
Corporations got away from funding them themselves and having a defined benefit opposed to defined contribution.
And defined benefit was your pension.
Yes.
They quit doing pensions. They said, well, no, you save the money. And that's why we're in the problem we have now.
But we like to help people define their benefit with a self-pension.
That's right. You can create your own pension, but a lot of it boils down to having the right retirement plan. But there are ways you can limit the amount of RMD. Like I said, you keep working. Once you're set, then your 401k, you don't. But if you ever rolled a 401k out into an IRA,
good point,
you still have to take it even though you're working.
But your 401k at your existing job, if you're still working past 70 and a half, keeps on going until you do retire, and then it starts.
And you can also do a QLAC, which is a qualified longevity annuity. You can take out, let's say, $100,000. It's limited to 25% of your IRAs. You can put in there and defer an income to up to 85. That part, you won't have to take 4% out of that piece because that's already going to create an income stream later. And so, stay on the job. Make sure you account for RMDs in all of your retirement planning.
It's funny. You like numbers. I like numbers. We deal with them all the time. It's kind of a double-edged sword for the government, right? They have to pay out the most money now because the baby boomers are all collecting Social Security. However, the other side of that sword for them is they're getting the most revenue now, right? Because the baby boomers, the largest group, have to take this money and are getting RMDs on that money going to the government.
There's $14 trillion in retirement accounts.
Yeah.
The taxes, even at 15%, are like $2 trillion.
That's right.
And so it's a pretty strong number.
That'll reduce our debt by what, 10%?
Right. It's funny, like I said, some people always say the Roth conversion, that was a gift from the government. No, it's just a way to get their tax money over 1 year or 2 years instead of 30 or 40 years.
It's time value of money. That's right.
It's a lot, and they're not reducing it at all. They're actually getting increased amounts because in the Roth conversion, all that goes to taxable income for that year. So you might make $100,000 a year, but you roll over a $300,000. You made $400,000.
That's right.
So they got even more tax money.
So instead of what Victor's saying, instead of 15% a year, right? If you're taking 4% of that $300,000 each year, they get 40% of $300,000, give or take.
So the government did not give you some great deal with a Roth IRA. They did something for themselves.
They weren't thinking of us.
Yeah, it is shocking, isn't it?
Damn it!
All right, what's the next question, guys?
We got time?
Yeah, we are.
All right. Question is.
Started anyway.
Well, let's start it. Is there any way to prepare for a cognitive decline later in life?
Suicide pact.
No. Dr. Kevorkian, right?
Yeah, call Dr. Kevorkian. He's passed away now, isn't he?
Yeah.
Oh, he did.
Did he pass away in jail?
I don't remember. The one thing is, people don't realize, you always hear of someone else, some relative. There's mild cognitive decline, too, that might not be dementia. But it's pretty significant. Half of 80-year-olds, people in their 80s, have it.
Is it because we're getting older, or does it really seem like more and more people are getting that, and Alzheimer's and all of these things that are related?
I read somewhere that the turn of the century, the average age was like 1800, was like 37.
Oh,
they never got old. Everybody goes, there's more cancer now. There's more dementia. Right. People are living more now, I think. And so you're getting those kind of diseases.
Got it. Makes sense.
We'll go over more things about cognitive impairment
Declines
when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you'd like to take advantage of our no-cost, no-obligation written retirement plan, stress test, and Social Security Optimizer. The Social Security laws changed in April or May, and so you need to have, if you haven't had that done in a while, you need to have it done again because the laws have changed, and so it needs to be updated. Our number is 972-715-2424. Again, 972-715-2424. If you're toll-free, 1-800-McClure. You can always go to ilovemyretirement.com.
And if you just want to call and chat, you just have a couple of questions, maybe you're not ready to go through the whole process of an analysis of all your finances. We understand that. Feel free if you'd like to call and talk to Victor or myself. We're more than happy to spend time with you and answer what we can. We don't know all the answers, but if we don't know the answers, we certainly know where to get them.
Now, 972-715-2424. Okay, the question before the break was, how do you plan for a potential, cognitive impairment later on? Well, the best way is to have a plan for it. If you plan for it, the transition will be better and everything else. They did a study. It's a Harvard. At age 51, they would give you 10 nouns, okay? Cat, dog, horse, whatever. And at 51, 6.2 would be able to be recited back. 6.2 out of 10. It was less than 3 out of 10 once you get over 80 or something.
Huh.
I don't know if I could do 6 out of 10. I'm not sure. Unless it were real easy ones like cat and dog and stuff like that. But you have to Well, one way to prepare for something like that is to open the lines of communication, especially with your family. Keep your family in the loop of things. Because if, let's say, you're the person that takes care of the finances, you might not know when you're declining. So you have to have some of these checks. If you have an advisor, they can help as well. Have a trusted advisor that can help you through times like this. Because, but remember, your plan has to address potential nursing home stays or anything like that too.
Absolute powers of attorney.
That's right. Living wills, medical directives.
Absolutely.
Durable power of attorneys, healthcare appoints. What happens is you don't just automatically die suddenly. That's, even though it's terrible.
And we all,
face
it, we all like to kind of go to sleep one night when we're 95 years old, and that would be it.
You're impaired in some way. You might not know you're impaired in a certain way. And then things still have to be done. And you don't want the livelihood of your remaining spouse or both of you to be jeopardized because of bad decision-making down the line. Durable power attorneys are pretty good for that kind of stuff. Gifting strategies, trust. You got to look at your estate planning. What happens is people let it happen, and then now it's an emergency. Okay? If you can do proper financial plans and retirement plans, they need to be stress tests, just like we talk about a stress test.
Yep.
This was from the Harvard study. They need to be stress tests. You can't have a plan. I see all this from these big firms. No, if you'd have bought our managed program and this mutual fund, look, it's never gone down this and all that. You've averaged 9.9% a year and blah, blah, blah. That means nothing. That's not a stress test.
No.
You just took an average account. An average account, average return means nothing if it ever has anything goes wrong.
Especially in the withdrawal phase.
That's right. You're in the withdrawal phase. The market goes down. It's a death spiral you can't get out of.
The problem with these financial plans and these medical directives and all of that, most people don't realize how easy they are to do. But as easy as they are to do and outline and set up, it's even easier not to do. And it's real easy to put it off and think you'll do it later. And what happens, just like a financial plan, they don't get done.
I mean, when you've got a financial, investment, estate, medical plans in place for a possible cognitive decline, transitions become a lot more fluid, less combative. A trusted advisor, will already know the family and can quickly, coordinate action steps for relatives and other things like that and help you really get through that period of time. And so it's real important to have open communication, have a trusted advisor. If you manage yourself, maybe have one in the back burner, a trusted family friend that's knowledgeable and things like this. It's typical to have someone older than you because people trust people. Yep. In this case, you're going to have somebody a little younger.
The opposite. Yeah, right. You do. Definitely.
What's our next question, guy?
Oh, hang on a second. I put the questions down. All right. Next question. Since I have a pension, should I exchange my IRA for a Roth IRA to help with future taxes?
Yeah, we went over that a little bit a second ago with the Roth IRA was the government getting the taxes up front.
More quicker.
And more of them, right?
Yep.
But there are sometimes you should convert a Roth to a regular. People don't realize it. If you're in a tax bracket while you're working, right, that's a certain tax bracket. Mine is ridiculous. Of course, I hate paying it, but you got to pay it. All right, I digress.
You could make less.
That's right. But when your check runs out, typically, even if the tax rates go up, you're in a lower tax bracket. If you're making $200,000 a year, and all of a sudden you got a pension of $50,000 a year and Social Security or whatever, you're not going to be in the same tax bracket. So therefore, you are deferring at a higher number, coming out as a lower number taxes. Therefore, the regular IRA is better for 90% of people. But there are exceptions, and we'll go over that after this break. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're going over your financial questions. If you have any financial questions and you'd like them answered on the air or you'd like them answered in person, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. You can always go to our website at ilovemyretirement.com.
I think just before we went to the break, Vic, you were wrapping up the question. Since I have a pension, should I exchange my IRA for a Roth to help with future taxes?
Right. Typically, you're in a lower tax bracket, so he said most retirees, since they don't have a paycheck anymore, and pension, Social Security usually don't equal your paycheck, they should not convert a regular IRA to a Roth IRA.
Basically, you'll retain more of the money if you don't, I believe.
Right. Think about it. Let's say you make $200,000, you got a $500,000 IRA. You convert that to a Roth. All the government sees is you made $700,000 that year. So you just went from a 25% tax bracket to a 39.5% tax bracket. That's number one thing. And if you just left it in there, taking out income from it, you might be in the 15% tax bracket or 10% tax bracket. I see a lot of people pay no taxes on IRA withdrawals because their income's pretty small and they're living off that money in retirement.
Boy, we are all about the numbers, aren't we?
Oh, there's one reason why Roth IRA, there's a couple of them. They don't require RMDs, which is good, right?
Yep. You don't have to take them. Yeah,
you don't have to take them out. That's right. But also, let's say you're in the top tax bracket. Let's say you're a wealthier individual. You know you're at the top tax bracket now, and then when you retire, you are still going to be at the top tax bracket. There's really no way out of it. Well, then converting from a regular to Roth makes sense because you're protecting yourself against future tax increases. But that's one of the only things. I see it all the time where somebody, they only make $100-something grand a year and they only expect 50 or 60 in retirement, and they roll it over. I'm protecting myself against taxes, and they just cost themselves a fortune in taxes.
It's like the old thing about buying tax-free bonds and getting a lower rate when you're not in the highest tax bracket to really maximize it. I've got clients that are good folks, good clients, but they'll do anything not to pay taxes to the government. And they think by converting it now, they're not going to pay taxes later when they're actually giving them more money. And you try to walk people through it, and it just doesn't seem through.
It's just math. Sometimes your after-tax is a lot more bigger number than your tax-free number. So you got to look at them apples to apples. If I paid tax, which I hate tax, I hate paying the government, blah, 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 all they do is waste the money. I get all that. But more money is more money.
Yep.
And that's the way you have to do it. All right, what's the next question?
Effective and efficient. Okay. My father passed away, and my mother is in poor health. She's going to leave us a sizable inheritance. I don't have an advisor. Should I stay with their advisor after she passes?
Absolutely not. Our number's 972-715-24. I'm kidding. No, there's a weird thing. When people pass away and leave an inheritance, what do you think the percentage, guy, that actually leave their parents' advisor is? Just take a guess.
I'd say 100.
It's 98%.
Yeah, I'd say 100. I tell you what I would think, just off the cuff. I don't know where you're going to go with it, Vic, but I would certainly recommend that you sit down, figure out what they did and why they did it on everything, and get the whole picture, and not do anything for a while till you settled in and you just get through the emotional part of the whole thing.
My point would be to interview that advisor.
Absolutely.
To interview several. Because sometimes your parents, even though when we're younger, we think our parents are idiots. As we get older, we realize, hey, maybe they weren't too smart. They were pretty sharp.
Yep.
That's what everybody does, right?
Yep. Are you listening, Mom?
I remember my oldest son, who's a professor, and he always thought he was so smart, but so we took an IQ test, and he goes, "Oh, this has to be wrong." I go, "Yes, your father is not an idiot. I know that you think he is. For some reason, you said school is much harder now than it was then. Your art college was nothing like engineering. I get it."
That's right.
But you do want to interview that your parents, because they might be a great fit for you.
Yeah.
Don't automatically, because what they're afraid of, they want to separate from their parents as far as that goes. It's their money now. They have different objectives, but sometimes your parents picked a good advisor. Also, that 55% of widows also move. So this is a person that chose the advisor, but they chose them together, and one leaves, one passes away, and only 50% stay. That's an interesting set. That should still be a consideration, because that person know you together. They might have made a plan before that addresses you being together or one of you passing away. And so you need to do that interview process very as
carefully,
detailed as you can, and carefully. All right, what's the next question?
All right. I was considering buying a guaranteed income solution to supplement my Social Security, but my current broker thought it was a bad idea. Do you get a lot of that when you're implementing your retirement plans?
All the time, don't we, Guy?
Absolutely.
It's a weird thing.
Go ahead.
Oh, yeah. You spend, this good example was recently. We spent 5 or 6 hours together with this client.
Over a couple meetings.
That's for several meetings. We spent 8 or 9 hours in background, gathering all their information.
Modeling.
Risk tolerance, objectives, how long they're going to be, the longevity of their family, all these different things. And then to come up with several solutions. And then the person on the other end of the line, when they said they're doing this, gave them another solution. They don't know anything about them.
The person
first time they've ever talked to.
At their brokerage firm as they were transferring out the money that they've never talked to
That's
before.
Right. Now they're trying to give you a suitable recommendation. They don't know you ever, and they've talked to you for 3 minutes. It's just
and then they tell you we don't know what we're saying, or the transferring.
Right. It's the conservation department. All of these firms that you're transferring money from one to the other, they have something called a conservation department. It is natural. What they figure is, if I give them one doubt, this other advisor could have gave them 10 reasons, really good reasons to do something. If I can just put 1 ounce of doubt in their mind, like, oh, it's a terrible idea. Well, do you know about this? Oh, no, we heard it's bad. They know nothing about it. They'll tell you that they'll get about 20, 30% retention just from something like that. 1 ounce of doubt. So obviously it's normal for your current advisor to not say it's a good idea. There's other reasons too, and we'll go over that when we return from the break. Remember, if you have any financial questions or you'd like to take advantage of our no-cost, no-obligation retirement plan stress test and Social Security optimizer, call our hotline at 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks, listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're going over your financial questions. Remember, these are questions from personal interviews, emails, from phone calls. Anytime we find one that we think will appeal to a mass audience, we're going to share them with you. Guy, what is our next question?
All right, next one's a good question. I like this question. I heard the argument that active management is better than passive management. I have both types of managers, and the passive one is killing the active management. Is it time to reconsider active management?
Let me define active and passive management. Your buy and hold is passive management. They believe you should rebalance and things like that, but you put a core together. A simple one would be, all right, I'm a 60-year-old. I put 40% in equities, 60% in bonds. Now we diversify the equities and the bonds. The equities between large cap, small cap, international, blah, blah, blah. And the bonds also have different maturities and different types of fixed income.
And keeping them balanced.
Right. And as one outperforms another, you got to rebalance to regain those same percentages.
And what do? You sell the winner and buy the loser.
That's right.
Go figure. You do.
That's hard to do. Otherwise, you'll end up with the same asset class like in the 90s.
Yeah.
Everybody didn't start with all tech stocks.
That's right.
They ended up with mostly tech stocks and they never rebalanced. Because they're like, this thing made 80% last year. I got to sell this to buy this other crap?
Yeah.
Yes.
And if you didn't, you had 100% tax or 90, and then it crashed.
And you took the 70% tumble, right?
Exactly.
But that's passive management. Buy and hold, a lot of your Vanguards, things like that, index type investing. People always ask me, well, you're a broker. You hate Vanguard, right? I go, I love Vanguard.
Good company.
There is nothing wrong with index investing. I like ETFs a little bit better because the fees have come down with about the same or close. But you can sell them intraday.
And they settle, yeah.
Yeah, so it's a little more to my liking. I don't like putting in an order at 9 o'clock in the morning and a flash crash is happening and I don't get out till 3. All mutual funds, including index funds, you get out at 3.
End of the day.
But if you've got closed-end funds or some of the ETFs, you can sell them 9:01, right? Might take 9:05, depends on how quick
you get it filled. That's right.
But active managers are trying to take advantage of disparities in the market. They're trying to hedge against losses, all this kind of thing. So what has happened is the market's gone up and it hasn't gone down since 2008. Remember, it crashed really hard, 50%, then went back up. Well, it's actually not made anything in like 18 months, but it still hasn't gone down. And so if you are an active manager, remember, you weren't 100% in the market. Those people wouldn't have lost anything. They wouldn't have made anything, but they've taken that full bull market. But if you were hedging, there's a cost to hedge account. In other words, you're protecting against losses. And so there's a cost to that. So you should have underperformed. In a bull market, you will underperform passive managers. It's when the market does correct, which it will and always has. Then you take the average after a correction, the active managers rise back to the top. But it has been 7 years now, 8 years. And so that's when you'll start see people bailing out of active management.
You know, it goes hand in glove with that. The old question, it's not on our list, but, you know, should I do a fee-based account or a transaction-based account where you pay for each transaction, or whether I pay a fee on a growing asset every year? And that kind of goes to passive and active. If you're going to buy and hold, then you might as well pay the transaction cost, because you're not paying 1% or 2% on all of your assets every year. It makes more sense. But if you're going to trade the account, you're going to have lots of transactions, then perhaps fee-based is better.
That's right. You know, we are fee-based managers. But I will tell you the truth. When it comes to certain types of management, paying an upfront fee or nothing, you know, if you do it yourself, is better.
And we've directed people that way many times.
Vanguard should give me like a free computer. I have sent so many people to them. E-Trade too. E-Trade.
That's right.
Because remember, there's nothing wrong with managing your own money. I happen to be a financial advisor for 30 years. So is Guy. And we'd love to manage your money.
If you can take the emotion out of it. A lot of you can't.
If you have the chutzpah, you know, and you have the knowledge, there's nothing wrong with managing your money. And when I do it in that capacity, if you're okay with buy and hold, there's nothing wrong with an index fund or an ETF. It's just some of us get to a certain point. Remember that question we had earlier about loss of cognitive function?
Right.
Well, an advisor might be a good choice for that. Or you've done it this way, but now you're retiring. Is there a difference between the distribution phase of your life and the accumulation phase? There's a big difference. And even though you've managed your finances for 30 years, you have zero experience in the distribution phase.
And if you like to manage your own account, if you allow us to set up some sort of income solution for you where your hard expenses are taken care of, it makes your job easier on the stuff that you're managing.
Yep. All right, I think we got time for one more quick question. Skip number 7. Go to number 8. That one we already talked about.
Oh, yes, we did. All right, number 8. I'm not sure whether to roll over my 401k to an IRA. What are the pros and cons?
The pros are pretty broad as far as you can get a million different investments when you might have 5 choices in the 401k. The negatives might be sometimes you're with a big company and they've negotiated such low fees. If you're okay with those 5 or 10 choices, you can get them for really low cost. So keep it in a 401k and bet. Or if you're going to work past 70 and you don't want to have RMDs come out, that is another way to keep one in there. But I'm telling you, it usually far outweighs the benefits of rolling over, because you could do a guaranteed income stream, a future income stream, plus pretty much every stock you can find outside or mutual fund you can get in an IRA. And so you're just going to really broaden the amount of products you have and choices you have by the IRA. But remember, there are always 2 sides of a coin, so you can always do the other 2. Well, that's our show, folks. I want to thank you for listening today. Remember, if you'd like to take advantage of our no-cost, no-obligation retirement plan stress test, Social Security Optimizer, or you just have a financial question and want to chat, our number is 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure, and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice